The Loser's Game by Charlie Ellis. This is very interesting. There was a guy named Cy Ramo. He was the R in TRW, and very smart. And Cy Ramo wrote a book, and it was about winning at tennis. But what Ramo said is that there are two kinds of winning tennis players. If you look at Pete Sampras or Nadal or Djokovic, how do they win? The winning champion tennis player wins by hitting winning shots. He hits shots that the opponent can't return. They're either so well placed or so strategic or so fast and hard that the opponent can't return them. And if Nadal hits a shot which is not a potential winner, then his opponent can probably put it away because it doesn't have enough difficulty on the ball. So the championship tennis player wins by hitting winners. The amateur tennis player, like him and me, we win not by hitting winners, but by avoiding hitting losers. And we believe that if we can just push it back 20 times and just get it over the net 20 times, our opponent can only do it 19. And we believe that we'll outsteady him, outlast him, and eventually he'll hit it into the net or off the court. We'll win the point. But we'll win the point without having hit a winner. So there are obviously two styles of tennis. And so the same is true for investing. And so Charlie Ellis wrote an article called The Loser's Game. He thought amateur tennis is a loser's game. It's won by the people who avoid being losers. Charlie thinks that investing is a loser's game. And so the best way to win at investing is by not hitting losers. Now, I believe also that it's a loser's game, not as much as Charlie believes, and not for the same reason. Charlie believes that investing is a loser's game because the market is efficient and securities are priced right. I believe there are inefficiencies. I just think it's hard to consistently take advantage of them, and you have to be an exceptional person to take advantage of them on a consistent basis. And you know, the reason that the pro can go for winners is because he is so well schooled and practiced that the ball will go where he wants. He doesn't worry about miscues, wind, sun in his eyes, distraction. He's so well schooled. And in fact, you know, in scoring tennis matches, they keep track of something called unforced errors. And the reason they keep track of them is because there are so few. The pro doesn't make a lot of unforced errors. We make unforced errors all the time. And so we have, in order to survive, we have to avoid them. So the point is, if you're going to be an investor, you have to decide, am I good enough to go for winners, or should I emphasize the avoidance of losers in my approach?